Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about the massive shift in interest rate policy that's taken place in a very few short months. But first, I love to answer your questions. We have AMA episodes, that is, Ask Me Anything. If you've got a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. On today's show, we're talking about the massive shift in interest rate policy that's taken place in a very short time period. Last week, the Federal Reserve announced its interest rate guidance for the current period and for the remainder of the year. Back in December, the Federal Reserve increased short-term interest rates by 0.25%, and at the same time, Chairman Powell also forecast 3 rate increases for 2019. In a stunning reversal, the Federal Reserve is holding rates steady and is forecasting no further increases in 2019. Last week, the Bank of Canada also announced its rate guidance, and it too is holding rates steady. The European Central Bank also has kept rates steady at essentially zero or negative interest rates. All of this is against a backdrop of slowing economic activity on a global basis. The growth forecast for the U.S. economy has been revised to 1.75% to 2% this year, down from the last estimate of 2.25% for 2019. Charles Evans, president of the Chicago Federal Reserve Bank, was speaking at an investment conference hosted by Credit Suisse in Hong Kong earlier this week. In his comments, he's not expecting to see an interest rate increase in the U.S. until the second half of 2020. Central bankers have been using interest rate policy to engineer the so-called soft landing. Briefly raising interest rates would prevent the economy from overheating. It would also give the central bank a tool with which to stimulate the economy, that is, by lowering interest rates in the future, should the economy slow down. Now, Europe has lost that ammunition to stimulate the economy. By maintaining rates low throughout, they've got nowhere to go. You can't really put interest rates much lower than zero, and printing money is the only tool they have left. They're going to try it, but it hasn't worked so far. I see no reason for printing more money to start working now. Here in North America, all of this is good news for real estate developers. One of the biggest risks we face as developers is the uncertainty of interest rates once a construction project is completed. However, a period of interest rate stability makes it much easier to budget and model in the future. Construction projects are typically funded by construction loans that are interest only during the construction phase. Upon completion and on lease-up, the projects are typically refinanced into permanent, fully amortized loans. Without knowing what interest rates are going to be in 18 months from now, it becomes very difficult to forecast the operating model for the project with permanent financing. So now is the time to take advantage of those low rates and lock into permanent financing for as long as you can. At some point, there will be another credit crisis. There will be a lack of liquidity. We know that credit markets cannot expand exponentially forever. They will break down eventually. At some point, the debt service becomes too high and the economies can no longer afford to service the debt. We've seen this throughout history. And governments will try and print their way out of the mess. And Europe is going to start doing that now again. We have several economies in Europe that are in fact shrinking. France and Italy are the most notable. The other factor to consider is that some permanent loans are not tied to short-term interest rates. Rather, they're tied to the 10-year U.S. Treasury yield. The yield on the 10-year U.S. Treasury bill will fluctuate up and down even during a period where short-term interest rates are being held constant. This can be an opportune time to rate lock or refinance for a long-term loan. In response to the Fed announcement last week, the yield on the benchmark 10-year Treasury note fell to 2.537% from 2.614. That's almost 1/10 of a point in just one day. It's trading at its lowest level since January of 2018. This means that long-term non-recourse loans will likely carry an interest rate near 4% for the duration of the loan. As the pace of new construction has slowed, many lenders are seeing the pace of loan origination slowing down. That translates into lower business for the bank. They look to refinance activity to supplement new loan originations. I expect lenders to get more aggressive in their lending offers. As you're thinking about that, take a look at your portfolio for projects that could be refinanced and rate locked into some long-term permanent financing. Have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.